Hello and welcome to another episode of the Opportunity Podcast. I'm your host, Greg Elfrink, head of marketing over here at Empire Flippers. And today I am talking to my buddy Kyle. He is one of the main men at WebStreet. If you guys aren't familiar with WebStreet, they used to be called Empire Flippers Capital. One of our sister companies is now spun off officially into his own independent organization. And what they do is they basically help everyday investors to get a piece of the digital pie by having fractional ownership into cash flowing digital assets that pay them quarterly. They've done, I believe he said, 5 raises so far, or with over across multiple funds with different portfolio managers buying different types of businesses, everywhere from your traditional affiliate content site to Amazon FBA. They're starting a SaaS fund coming up soon, and there is a new opportunity if you want to own an actual piece of WebStreet itself. Right now, at the time of this recording, there's probably going to be less than 2 months, I think. But right now, there is an opportunity where you can own a piece of WebStreet. Now, you're not going to get paid quarterly dividends like you would if you're investing in WebStreet's products, like the funds, but it is a chance for you to own something that could be quite large. And to be honest, I think Web3 personally has the power to grow much bigger than even Empire Flippers because unlike us, where everyone wants to be an entrepreneur, not everyone has the appetite for the risk, the capital, or really just like they don't want to do any work, right? And when you buy a business, of course, you're going to have to do some work to make it go. Versus with Web3, you can just give them your money, the operators, the portfolio managers, they take care of the rest. It's extremely passive. So I think their chance to grow much bigger than us is quite high. So if you ever wanted, like, man, I wish I could invest in Empire Flippers at the beginning, well, here's round two. And to be honest, it might be a bigger round. Anyways, with that said, I will stop rambling and I will see you on the other side with Kyle. See you there. All right, Kyle, welcome to the show. I'm glad you're here. It's been a while since you and I have done some actual content together between our sister companies. But for people that don't know the legend of Kyle Kuderewski, which I just put your name and you just told me how to pronounce it last time. For people who don't know your legendary status, tell our audience a bit about yourself and what you do.
Hey, Greg. Glad to see you again, even if we're on opposite sides of the world. First time my name's ever been mispronounced, so shame on you.
Hey,
Yeah,
I'm all about that blue ocean, man.
all good, all good. Yeah, my name's Kyle Kuderewski. I like to say I'm an engineer kind of turned investor. Been with Empire Flippers Capital, now WebStreet, for about 2 years now as currently an operations manager role. And yeah, like you said, glad to be catching up with you.
Awesome, man. Yeah. So you guys started off as Empire Flippers Capital. Mike Frankovich, who runs it was always his brainchild. I remember 7 years ago when I first joined EF, he was running the very like baby version of it. And then there was a couple of more renditions before he finally figured out a way to really make it work. And now you guys have been off to the races. So you guys have rebranded now from Empire Flippers Capital to WebStreet, which I think is really cool to see what you guys are doing over there. So tell me a bit about the update. It's been what, like 5 months, 6 months since we did the split officially? What's been going on since then?
Yeah. So just like you said, about 5 or 6 months ago, we completed was, it took a little while. What was a pretty large undertaking. It was a planned separation from Empire Flippers. We can get into all the reasons why, but that involved a completely new tech stack, new branding, new domain, all the legal side of that. And, honestly, a lot of that was harder to pull off in a separation fashion than starting from scratch, especially on the tech stack side. But three main things. So we completed our first investment round as a standalone entity as WebStreet. That included 4 funds, 1 repeat operator, and it was our best round since all the way back to round 1. We raised $5.3 million. We completed our first acquisitions outside of Empire Flippers, which was one of the reasons for the separation. We did
Shame on you, Kyle. Never speak such ill words again. The
I was
shadow of
waiting.
the empire is long, my friend.
I
No,
was
that's
waiting
great.
on
That
that
is
one.
one of the reasons why we wanted to do that, right?
100%. Yeah. I mean, obviously, we love the businesses that come through Empire Flippers, but to scale to the size that we know is possible and that we want to, we simply need more deal flow. So we did some through other brokerages, and we did our first private deals as well. We did distribute to investors as well. Our Q1 distributions went out to previous investors. Those average between 3% and 4% on the quarter. Those are like I say, cash distributions. And our highest fund actually ever, our highest quarter just went out, and that was 10% on the quarter. So really excited about that. And then, just kind of wrapping it all up for anybody that's, I guess, been keeping track or maybe hasn't been, that's in the last 2 years, that's 5 rounds under our belt. So 27 million plus raised, 34 businesses acquired from about 400 investors.
That's amazing, man. I remember the very first round when it was still basically just Mike. And I was like, hey, how's it going, Mike? Is it like you're officially doing this? You're full time in it. How's it going? He's like, it's insanely stressful. I think all my hair is turning gray. I was like,
Yeah,
yeah,
it's
that sounds
funny.
about right with fundraising.
Yeah. It's funny you mentioned that. So, I mean, just a little bit more background on me. I went to engineering school and I joined a traditional corporate America role. And the way I found Empire Flippers was after, deciding I kind of wanted to exit corporate America at some point. I had saved up money, was looking for a side hustle, looked at going into online business industry. I ended up going a bit of a different route and got into vacation rentals, but I kept my eyes on Empire Flippers and the industry as a whole. And in those early days, I actually looked at investing with EF Capital. I had a sales call with Joe, and that's really how I got to learn about the opportunity. And then once, again, kept an eye on it, and as they started to scale the team, decided, this is something I believe in, and I'm going to take a shot and see if I can become a part of the team. So I joined some of those early days right after when you're talking about.
Yeah, you came on shortly after that. My story joining EF is semi-similar in that I was building an affiliate site about beards, if I remember right. It was either beards or DJs, something like that. And I reached out to EF customer support to see like what's the best way to like build it and make it very sellable. Never got a response back because their service wasn't great back then. And that's how I got on the email list. And I was still working in the oil field, saw the email like, yeah, I want to get out of this. It wasn't corporate America, but it was another kind of special hell for sure.
Yeah, understood completely.
So you've raised quite a bit. You said it was 27 million, right?
That's correct. Yep.
Yeah, that's amazing. So now with what you guys are doing, talk to me about what new investment opportunities are coming available because I believe you guys are starting a new fund, right? This is like fund five.
Yeah. So we just wrapped up our fifth round, which was about 13 or so funds. Like I said, in those rounds, we're always in different periods with each one. So, we're either raising, but while we're doing those raises, one of the previous rounds is acquiring and the other businesses are growing. So it becomes a lot to keep up with. But right now we have some that are in the acquisition period, and we just opened up a new opportunity. Now, this one is different than our normal opportunities. So we're actually now allowing people to invest directly into WebStreet. So you can own an equity stake in WebStreet as a company. And we can get into, of course, all the reasons why and the opportunity, but that's now open. And that's going to go on for about 2 months. So depending on when this airs, by the end of July, that opportunity will be closing up. So if you believe in the model and the online businesses and digital assets will continue to grow, it's a great opportunity to own a piece of a company that's at the forefront of making these assets available. It's something a little different than, Empire Flippers. I don't believe it ever raised money. It's something that we're going to try and do differently because we see how big the opportunity is. We want to grow as quickly as possible and have that first mover advantage, build as big of a moat as we can. And so, yeah, it's a different type of opportunity, and we can go into all those details.
Interesting. We'll make sure to publish this like 2 days before that closes to add some scarcity for you. A little marketing help from your friend over here, doing what I can. But no, that's cool. If I remember right, you guys raised money not too long ago for WebStreet before, right? So this is the second time you've done this?
Correct. Yeah. So we raised about a year ago from about 50 investors. And the reason we're doing this again is it's multifaceted. So, now we're a year further down the road. And since we've gone out and become a standalone company, standalone team, tech stack, and most importantly, have begun to analyze the broader market and the deal flow and doing deals outside of EF, we believe the opportunity is even bigger than before. So we want to scale faster. And like I said, we really want to build as big of a strategic mode as possible and take advantage of the first mover advantage. We know somebody's going to get this right, and we want to make sure that we're at the forefront of it. There's a lot of work to go, but we know that we've done a bunch of heavy lifting thus far, and we're just ready to scale. Additionally, we think it's a really good investment opportunity for our audience and the EF audience, people that, a lot of people that invested in us last year invest in our normal rounds. So they have now two types of investments. They've got these cash flowing assets where they're getting quarterly distributions on those businesses, but now they also own a piece of the company that's making it all happen. So we're opening it up again, for the next month and a half or so.
I'm assuming you guys are raising for like growth fuel, or like what's the plan? What you're doing with the money?
Yeah. Yeah. So last year was really just all around the separation, building of the website, the brand, legal, all of that. The team's in place and it's essentially growth fuel. So we have a full engineering agency on board. We want to do a ton around marketing to expand our audience, which I know you can appreciate outside of EF and even outside of the online business industry. We know that based on what some of our competitors are doing outside of online business industry and art and wine and whiskey and collectibles, we just want to continue to grow that audience. So a lot of marketing, we want to make major updates to our platform. Our platform works great, but it doesn't have all the bells and whistles and investor dashboards and scoreboards, track records, that type of stuff. So yeah, we're going to continue to invest and kind of delay gratification, delay those cash flows, and make sure we're building as strong as a company as possible.
So if an investor wants to invest into WebStreet, like what is it? Like what's the minimum? What are they getting? I'm assuming some sort of equity, but no dividends or something like that. Give me the overview of what the deal looks like for them.
Yeah. So the minimum investment is $60,000 for accredited investors. And it's basically, you get a share at a unit price. I believe it's around $1.30 per unit. And so you actually own that equity in the company. So the big difference between this and investing in a normal round is it's a growth play versus an income play. So with the normal round, you get those quarterly cash distributions, you're cash flowing, you're incoming, you're getting that income. And this is a growth play. The best way to think about that is you're not going to get those quarterly distributions or even annual distributions. It's an illiquid investment. It's a longer hold. We're thinking in the 5 to 10 year period. If we start to, cash flow sooner, we will distribute sooner, but that's not something anybody should count on. But the way you should think about it is you're owning a piece of all those businesses. So WebStreet profits when those assets, the normal rounds, when they profit. But we don't take profit if they don't. So you're owning a piece of every business that we acquire or that our funds acquire. So the better those businesses do, the better WebStreet will do, and the quicker and stronger returns you'll get as an owner in the company.
Oh, that's awesome. So the plan is to eventually have distribution for the investors, not just a liquidity play if you guys do a big exit.
Correct. It's not a guaranteed quarterly or anything like that where the normal rounds are more or less. So it's definitely a longer term hold, but if the upside is much larger as well. The projected returns are much larger, but it's a different type of play. It's not a cash flow play. So
Makes sense. That's cool, man. In terms of, 'cause, this might be probably, we should have said this at the beginning of the podcast, but there's probably a lot of people listening to this right now that maybe they haven't been following all the Web Street stuff in terms of what's going on there. So, in terms of the cash flowing investments that they can make, why don't we give a bit of an overview of what that opportunity looks like? Because I'm sure there's someone who's listening to this like Web Street, Empire Flippers Capital. What? What is this?
yeah, that's a good point. We probably should circle back to that. So in our normal investment rounds, we have, call it 3 to 5 funds that are run by our operators or portfolio managers. Those are some of the top portfolio managers we think in the world. We have a whole vetting process, through the EF network and outside of the EF network where we bring those portfolio managers in. People have the opportunity to invest in those funds, typically $1 to $3 million in range. And once those funds close, those portfolio managers go out and purchase businesses according to their strategy. So we have FBA operators, we have KDP, we have content, affiliate marketing, of course. Our next normal round will be later this year, Q3, and it's looking like we're going to introduce SaaS. We've been talking about that for a while. So our first SaaS operator will be later this year. So they go out, acquire businesses according to the strategy they laid out to investors. And once they acquire those businesses, they begin to grow them, implement their strategies, grow them. And each quarter, whatever profit they make is distributed. 2/3 of that profit is distributed to investors in the form of cash distributions. So it's a fractional investment, a fractional ownership model, similar to, like I said, you would see in art or wine or real estate. But one of the large differences is where in real estate, you may just be waiting for the asset to appreciate. These are cash flowing assets from day one. And then you also get the appreciation if they grow the businesses. So that's the normal model.
I was literally just on a podcast earlier today with a buddy of mine. He bought a SaaS business from us, I think around 500K, and him and his partner they've grown it in less than a year, I think by 75%. So it's well on track to basically doubling its valuation soon, which is a great success story, right? And I was talking to him about investing, and he runs a very successful agency. That's where he gets the fuel of his income. And he told me, like, yeah, I mean, it just doesn't make sense to invest in real estate when you have these skills that you can just buy something that has such an asymmetrical return. And it made me think, because like I love real estate, I'm a real estate investor myself, but it's true, like you can't buy a single family home and double the rent in 12 months. Like I guess you could, but
You
bad things
probably,
might happen to you.
yeah,
like,
you'd probably be vacant.
like, like, it's not like you can just like, all right, I just bought this $200,000 house, now it's worth $400,000 like 6 months later because of these weird tricks I did that the government probably wouldn't like that you did
Yeah,
if you even succeed with it, right? So I think online business in particular, you guys are in such an interesting space, and so are we as a broker of these. But the businesses, the asymmetrical bet, like it's not unreasonable to be able to double, a small online business within a very short period of time if you know what you're doing. Not that it always happens, of course, but it's far more realistic than the growth potential in real estate, I would say. I'm
100%.
curious.
Yeah,
Oh
go
yeah,
ahead.
go ahead.
I was
No,
just going
no,
to
go
say
ahead.
it's all about diversification. I mean, I'm going to sound like a broken record if I keep saying that, but we know that some of our funds are going to double, just like you said. And within the funds, you have to remember that they own multiple businesses. So one fund might own two, three, four businesses. So you have some diversification there, but you really want to do multiple funds as well. And because some are going to double and then some are not, some are going to be cut in half, a Google update or whatever the issue is. So diversification is key. And same thing with this play, talking about investing in WebStreet versus a cash flowing asset, with distributions. It's all about diversification.
Yeah, for sure. I think investing in Web3 can make sense. And like again, that buddy I just did the podcast with, one of the things he said, his agency originally served affiliates. And then he realized all the affiliates served e-commerce store owners. So he went to e-commerce store owners and those became his clients. The further you get to the source, the better the return that it can be. It could be riskier, like what Web3 does isn't providing dividends, at least at first. So that's a risk, but you guys are also the source of all these funds. When it comes to the operators, you mentioned that they own a few businesses. So that might be something of interest to the audience. So on average, how many businesses is each portfolio manager buying?
Yeah, I think I'd have to look at the numbers, but just a general sense, it's usually two to three. The FBA being less, usually, two larger businesses. I know one of our content funds has four or five.
Mhm.
So I think on average three within each fund. KDP, I think our KDP fund has two as well. So yeah, right in that two to three range.
I don't remember if this is the case or not. So I'm curious. So if an operator or a portfolio manager raises, say, like 2, 3 million, they buy 2 to 3 businesses. Do they use part of that money as growth capital as well, like as working capital for the business?
Yeah, so it's a case by case. They can certainly FBA. It's more common for growth,
That makes sense.
for
Yeah, that's a
for
very capital
inventory.
intensive business for sure.
Yeah, but that's all laid out ahead of time. So anybody that hasn't seen one of our fund pages, that's it may not be specific numbers because they don't know which business they're buying yet, but they'll lay out their strategy, and it's going to be X% for growth. Some of them are doing different things with ads, some of them are implementing or introducing new products and that type of thing. So it's really case by case, but yes, sometimes that is set aside for growth capital.
And when someone invests in the fund, I know there's that waiting period to make the actual acquisition happen. And then, if I remember right, there's a stabilization period after. So, what does that look like nowadays?
Yeah, so it hasn't changed too much. Generally, we raise the funds in a 2 to 3 month round, and then there's a 90-day acquisition period. What has changed is because we're confident in our model and that we're going to be able to raise the funds, these operators are starting to go out and search for businesses before the money is even completely raised. Now, obviously, they're not making offers with money that's not raised, but that helps them extend that 90-day window and make acquisitions quicker so that they can go ahead and enter migration and enter stabilization, like you said, because 90 days just isn't all that long to
It's
find
not.
businesses, do,
Yeah.
do due diligence, and find quality businesses and make offers and negotiate and all of that. So that's what's changed. They're going to the markets earlier because we're pretty confident in raising the money. So 90 days acquisition period, what we say 90 days migration and stabilization period, where they're starting to implement their growth strategies. And then beyond that is when we start to deliver the cash returns. A lot of them have 30, 60-day net terms as well with Amazon. So even though they're making money, it takes 30, 60 days
Yeah,
before
yeah.
the payouts happen.
But in terms of the like, I don't know if you're allowed to say this or not, so you can tell me to stop asking this question if that's the case. But are you allowed to say like what's the average return on the fund so far?
Yeah. So it's pretty set. It's between 3 and 4% across all the funds. That's per quarter. So that's right on
Okay.
track with what we're projecting. If you extrapolate that out, that's 12 to 15% per year. And that doesn't take into account the exit of the businesses. If the businesses grow, then we're on track to hit the 20% returns that we projected. But again, diversification. We had one fund this time that returned 10% on the quarter and has done 28% on a year. And we have had funds that have had quarters without payouts, either because of, seasonality or investing in inventory, whatever the case is. So it varies, but 3 to 4% is the average across all our funds. People should check out at webstreet.co. We actually just posted our first case study, our first operator case study. It was on a KDP business, and it has the track record across each funds in that case study.
Very cool, man. Those are great returns. In terms of the valuations in the market, we didn't exactly plan to talk about this, but I'm curious on your thoughts. So, like for us, it's not great. Sellers are getting worse exits. But in my mind, it must be awesome for you guys because, like, when you guys started, you guys were starting at the fever pitch. When we had people buying businesses and their due diligence process was like, is X making an offer? If he is, I will make an offer as their entire due diligence. Like, it's just like, let me buy you some swampland in Florida kind of mentality. It was really, really dangerous investment thesis is just flying around. That's a really tough market to compete in as a buyer who's not funded by literally hundreds of millions of dollars, which is what you guys were when you first started. But now that valuations have softened, and I think they're going to continue to soften over the next few months, and as sellers come to grips with the new reality of the situation, like I can't help but think this might be a really good thing for WebStreet because it should juice your returns, no? Or what are your thoughts on it?
Yeah, I mean, really well said. I don't have a ton to add there, to be honest. You pretty much nailed it. So, I mean, when I came on board, when EFC started, we were really excited about it and we were able to make good acquisitions, but it was extremely, extremely competitive at much higher valuations. And also, our processes weren't as well built out then. So now we're seeing valuations, come down or stabilize. It's definitely more of a buyer's market, which is part of the reason I should have hit on this earlier that, we're wanting to raise funds and scale quicker because we want to take advantage of this market and make sure our processes and people are in place to where we can build that strategic moat. And so, yeah, exactly like you said, it's a great thing for us. A lot of people that are looking to make the exit, not only can we get them at better valuations, but there's more opportunity to scale the businesses. People are just looking to get out. And then additionally, what we did in this last year, we brought on a investment analyst from Empire Flippers as well to help with acquisitions. Basically, we have outside acquisitions advisors. There's been a lot of things put in place to make our acquisitions more competitive and quicker, like I mentioned earlier, to take advantage of exactly what you're saying. So well put. That's really good analysis.
Hey, man, stick around. You can buy any of my analysis. I will happily take all Web3's money to put into the Empire Flippers marketing budget. But no, that's cool. That is what I thought. I'm glad to hear I wasn't crazy because I feel like while the opportunity for us for growth is really hard now in terms of like making a deal happen, like a deal that is done today would look like almost like a bad decision a couple years ago with how feverish it was from a seller's perspective. But now that's a
100%.
really good deal. But yeah. Oh,
Yeah,
go ahead.
100%. And one thing I guess to add on that too is, some of our funds have just crossed the 2 year mark or so and are getting into that range where we might look at selling the businesses. And, at this time, that's one reason that we give the range of time in selling the businesses and selling those assets is we don't want to be forced to sell them in a market where it doesn't make sense. If they're continuing to cash flow and we continue to just stay stable and give investors the returns that they want, we can hold those businesses for a longer period of time until it makes sense to sell them. So right now, that's the phase that we're in, and we're excited about it.
Yeah, that's a very good point. Because a lot of funds, especially in like PE funds, they will typically be 4 to 7 years, maybe 10. There's one very weird example with permanent equity where they do 30 years lockup of capital. I just had Brent Beshore on the podcast. Very
Yeah,
interesting dude. You guys
I
should
listened.
connect.
I
But
listened to that one. That was interesting. Yeah.
Yeah, yeah, he's a really cool dude. I read his book, The Messy Marketplace. I think I even said it on the podcast, but there's a part where he says, because it's all targeted towards the seller, right? And he
Right.
says, remember, Mr. Seller, when the buyer signs the LOI to look deeper into your business will never look as good as it does right now. It just gets worse from here. That is so accurate, you know? But yeah, anyhow, so you guys are getting close to that potential of doing an exit. Talk up to me a little bit about that because that's something I'm curious too. Because you guys haven't had a liquidity event yet. I know the market's soft right now, so maybe you guys will hold off. But what does the investor get in a liquidity event, and what do you think that might look like, and when you guys might do an exit?
Yeah, 100%. So I guess for kind of round numbers, I'm trying to do it as round as possible. Let's just say it was a smaller business. I mean, most of ours are larger than this, but if the business was a content site that was purchased at $100,000, say 2 years ago or whatever the window, it really doesn't matter. And it doubles in value, right? And we go sell it on Empire Flippers, of course, for
Of
$200,000.
course, yeah. Never
Um,
think otherwise.
so if we sell it for $200,000, that's $100,000 in profit, right? That means 66.7 or 2/3 would go to investors. So they would get, $67,000 divided by however many investors based on the percentage that they put in. So maybe the numbers aren't as easy as I thought, but two-thirds profit on the exit, just the same as normal profit during the life of the business. Now, a business that doubles, they've been getting cash flow all along for those 2, 3, 4 years. They're going to have really strong numbers. I'm not quick enough. It's been a while since engineering school to tell the total returns over the life of the fund, but a business that doubles is really going to pay off. I mean, it could be $1 million site that sells for 1.5. They're going to get 66% of that $500,000.
And the operator, the portfolio manager, can they choose to sell, like, say, just one of the brands and keep the other two, or do they get that kind of autonomy?
Absolutely. Yeah, absolutely. So that's a really good clarification. So it makes sense to sell one of the businesses that's just, gone to the moon or whatever, and hold the other two and continue to cash flow those. And so investors would get a nice windfall there and then continue to cash flow until the other two businesses are sold and the fund's ultimately closed up. And we expect that to happen. I mean, there's no way to time those, all in sync.
The only way to time the market is to always sell on Empire Flippers as soon as you can. No, that's cool, man. I was curious about that. So with the funds themselves, you've had operator or I keep calling them operators. That was the old name. I think
Yeah.
I helped Mike come up with the portfolio manager thing. That is like an ego boosting thing to the operators, and then now I keep calling them operators.
Yeah. We
But
all struggle with that.
yeah, with the portfolio managers, you've had how many repeat portfolio managers now that come in to do more funds?
Yeah, so we're on our fourth or fifth repeat. We've had a KDP repeat. We had multiple content repeat. Yeah, we're on our fourth or fifth repeat, and I believe one of the content operators is on his third raise, if I'm not mistaken. So that's really huge for us. We know there's tons of quality operators, portfolio managers out there. But yeah, for our model, we definitely want repeat portfolio managers to come in for many reasons. So investors believe in those portfolio managers, right? They can see their track record. If they're not doing a good job, we're not bringing them back, right? So that's pretty self-explanatory. But in addition to that, we're starting to build a really nice network of portfolio managers. They have regular masterminds, they're sharing strategies, and it's a really cool community that's starting to be built, which is something we realized kind of early on. It happened naturally, and now we've put systems in place to where they're helping each other out, even across monetizations. We've seen support from content to KDP and vice versa. So it's a really cool thing that's starting to happen.
That's awesome. I think that's very, very smart to have the portfolio managers meet and talk to each other. And the fact that they're doing it multiple times, to me, and I'm sure to you guys, is a sign of like, okay, this is working. Could it be better? Sure. Maybe we need to switch something, but people are happy to do it again. That is like proof in the pudding, right? So that's amazing. I'm assuming you've had a similar thing on the investment side where investors have come in on multiple deals, multiple raises, all that kind of stuff.
Yeah. Yeah. I don't have all the stats off the top of my head, but we have a really strong investor base that many of them have done every single round, or maybe they'll do every other round, just depending on their liquidity and whatnot. But the amount of investors that continue to return is really high. It's a really high percentage. And, one of the things that makes that really easy, if you think about other different investment models, where you can reinvest dividends and that type of thing. Ours isn't automatic like that or anything, but if you get these large cash distributions each quarter, say you're in 4 funds and then Q1 wraps up, we send you your distributions. They just hit your WebStreet wallet. So the money's sitting there. You can easily withdraw it to your bank account if you just want to take your profits, or you can roll it into the next investment opportunity with just a few clicks. So we make it super easy to continue to invest. And, of course, you can add to those funds and add to the money in your wallet if you want to invest more, but we make it super easy. And we're seeing a lot of investors just continue to do that.
That's great. That's very cool. So, with the actual raise for WebStreet, I forgot to mention this, but you guys are also doing a WeFunder campaign. Is that right?
Yeah, so we're really excited about this. So, since the early days, the EF audience and outside has asked for, non-accredited investor crowdfunding option. We tested through the waters on this in our previous round 5 on WeFunder, and we had, a lot of success with it. That those
Real
funds are
quick
in.
for the audience,
Yeah.
what is WeFunder? So
Yeah,
people know
good
what it is.
clarification. When WeFunder is a third-party platform, there's a few of them out there, WeFunder and Republic, and they allow investors to pool money in a crowdfunding vehicle, and then that comes to us as one line on the cap table. So that's how we're able to do that. To be clear, the terms are less favorable. Just because we're using a third party WeFunder, they have to take their cut, and they provide that technology. But it's still a really good option for people that are not accredited or want to do less than the $60,000 minimum. So the minimum that we're doing on that is $1,000. So you can own a piece of WebStreet for as little as $1,000 through our WeFunder campaign, even if you're not accredited.
And does WeFunder handle the payout in that scenario versus your guys' proprietary platform?
Correct. Yeah. So we essentially go through them because it's its own investment vehicle and it's a crowdfunding regulation. This all comes back to SEC regulations, right?
That's the most confusing, terrifying government organization.
Yeah. Yeah, but one of the nice things on the direct raise is because it's not necessarily a cash flowing investment, you just get to own a stake in WebStreet, which we've had a lot of interest and early excitement around just because, if you think about it, a lot of people are, there's big fans of Empire Flippers. If they could have owned a piece of Empire Flippers in the early days, that's the thing that would be really exciting to them. And so this is a similar proposition. And if you can do it even as a non-accredited investor, it's something a lot of people are interested in.
So is the WeFunder campaign only to own a piece of WebStreet then, or are you guys also trying it with the actual funds?
So we're trying it with actual funds as well. So we just did it. We just tested the waters the first time for round 5, and we had a good amount of success with it. It was a lot of work on the front end to get it all set up, but we've learned a lot. We've kind of got it figured out now, and yeah, so both things are an option.
Gotcha. I wanted to talk about some general online business stuff here, but before we kind of pivot into, the actual investment into online businesses, I'm curious when Mike first started this, when, Justin, Joe, myself, we're all sitting down and talking to him, masterminding about who the target market would be. We made educated guesses, but in your opinion, how has that guess been? Has your realization of who the target market has it that changed with new data? Who are these investors? Are they other entrepreneurs? Are they blue collar folk? Are they someone else?
Yeah, it's a wide range. We definitely see a lot of entrepreneurial types and types that either have run online businesses in the past or just are familiar with the space. But as our audience continues to grow, we're seeing a wide range. One of the things that we've got to get to work on is some type of referral program. I know that took a while for EF to implement the strong version of that, but we're getting a lot of that as well, where people are recommending to family and friends, like, hey, I'm getting these cool cash flow distributions. You should check this out. But definitely entrepreneurial types. There's a lot of people that start they do regular stock market investing, 401k, all that stuff. And then once they get into the alternative investment space, you can go a long way down that rabbit hole. So we have people that have done other types of alternative investments that come find us and again, realize whoa, these are cash flowing assets. These aren't just something we're waiting to appreciate and jump on board. So I'm not sure if that was a clear answer, but it's been a wide range, but definitely the heaviest in entrepreneurial types. We have some I know that have run different agencies and sold businesses through EF and that type of thing.
Yeah, that's great. I always assumed that once you guys got going, your target market would actually be significantly bigger than ours because, while everyone wants to own a business, not everyone has the skill nor the appetite for risk, right? Even though buying a business is already profitable, so way less risky than starting one in a lot of ways, it's still okay, you don't just buy it and do nothing. These aren't index funds. Someone has to do something. And with you guys, it's so much easier because it is pretty much passive for the investors, right? It's hands off once they invest the money.
Yeah, 100%. And Yeah, tying it back, I mean, that's one of the reasons that we're excited for people to be able to invest in WebStreet is to continue to expand our market. We're seeing it expand. We're seeing the audience expand, but there's still a lot of education that has to be done. I mean, you know that in your world, the marketing world, like there's still a ton of low hanging fruit and a lot of people that don't realize that all these websites they're visiting are businesses. There's still a ton of education that needs to be done. And that's something we're going to work really hard on.
Yeah, it's endless. There's still educational opportunities at EF, even as well known as we are. So, yeah, I feel you. Let's talk about the benefits of investing into these businesses. So, I'm assuming almost everyone in this audience will probably already know the reasons. So, we're kind of speaking to the choir, but maybe there's someone who's just discovered this podcast. So, we already talked a little bit about them versus like stock and real estate, but what other benefits do you see when it comes to investing into digital cash flowing assets?
Yeah. Well, they can be fun and interesting for one. Sometimes there's a lot to be said for that. So you're getting quarterly reports where you're learning about the sites you're investing in. You're learning about what they're doing to grow these sites, what works, what doesn't, what's going on in the market. Of course, I've kind of beat this one to death, but getting that quarterly distribution in your wallet, watching that balance grow is a really nice thing. Other than that, diversification. I mean, stock market, 401k, but this is the internet, and as far as we know, there's not really many other ways to invest in online businesses and digital assets, SaaS apps, that type of thing. So we want to continue to expand the offerings that we have and just make it a, accessible asset class.
Yeah, I like to think what you guys are doing is kind of like democratizing investing into the real world. Like, because stock markets, yeah, it is a reflection of the market, but it's almost like a parallel dimension. Like, you have people, Wall Street bets going YOLO into GameStop, right? And that's not exactly a pragmatic reality of how business really works, right? Versus what you guys are doing, like, you are investing kind of on the front lines of digital Main Street and you're allowing people to participate in it. So, I think that is super, super cool. As you
I
guys
mean, it's a form
grow,
of digital
oh,
real
yeah,
estate, right? I mean, I'm
yeah,
like I said, I'm
exactly.
a real estate investor. You are too. I'm not saying anybody should shy away from that. Like, definitely put your eggs in different baskets, but it's a form of digital real estate. Who's
Yeah,
not visiting these different sites every day? Like,
I'm a fan of looking at online businesses. It's kind of like this is your growth stock, right? Like this is the fast growth stock. It's volatile, but you can make insane returns when it goes up. It has big risk of going down, of course, but when it goes
right,
up, it often gets rid of all the losses because of how far it can go up with the asymmetrical bet. But I often tell entrepreneurs like after you do an exit or some kind of big liquidity event, I think that's when you take like a portion of that to put into real estate. And I view real estate as kind of like income floor. So instead of like an income ceiling, you have an income floor. Like you're buying this not for growth, but for stabilization of your income. So it's like, yeah, you can appreciate and all that kind of stuff. But I always view like the only way to invest in real estate, at least for me personally, is cash flow. So I always view it as like the income ceiling. Like it probably isn't going to dip beneath this. It'd
right.
be like
I think
pretty
that's really
hard
well
for it to
put.
dip beneath this.
Yeah. I think that's really well put.
Oh man, all these compliments on my articulation. I
No,
need
I
to
mean, I
take
do. I agree with
notes.
you. I agree with you. Like, it's a great place to put your money, but yeah, it's a more of a
So as you guys grow, what do you think is the ripple effects that this kind of fractional online business investment opportunity is going to have on the industry at large? Like you've mentioned competitors, which kind of surprised me because I didn't think you guys really had any competitors. I knew there was one person I know that is a competitor with us that has something similar to what you guys are doing. But even he told me like you guys are way far ahead. Like I just hung out with him a few
yeah.
months ago. So
Yeah, to be clear, I think when I mentioned competitors, I really meant other types of alternative investments, not
gotcha.
necessarily online businesses. But we do think there will be ripple effects, and that's why we want to move quickly, even more quickly than we already are. Which there will be people try different versions of the model, and that type of thing. As far as ripple effects, I definitely don't have a crystal ball. I think it will be really, really interesting to see. I mean, we're going to have to be easy to adapt, as we're going to different brokerages, as we're going and finding private deal flow. I think it will definitely affect the market. I'm just not really certain how. Do you have any guesses?
Well, I think you guys will probably get some copycats for sure. Like, so as Empire Flippers grew, we were kind of looked at as like the alternative Flippa, and in a way, we copied them. Like, inspired, I guess would be a better way to put it, because we were pretty different. But
Right.
then as we grew, people definitely copied us. And what I found is usually they do. the ones that are the most annoying, at least, they do the ones where they offer 0% commission. So like, oh, we're not like the other brokers. We do 0% commissions. So you get all of your money and then they charge the buyer, right? Sounds good in theory, but usually what ends up happening is that broker, they realize I'm making no money, like, because the buyers aren't paying a monthly fee for this. You just don't buy a business every month unless you're like really big. And even Brent Beshore, who I think he manages close to $400 million, doesn't buy a business every month. Like, it takes a
Right.
long time. So like the monthly fee that a lot of these people charge, is a mistake. They realize it's a mistake, but they just did all this clout that everyone's talking about on Twitter to gain that initial momentum. And then they'll introduce a commission rate to the sellers, and they effectively become a discount broker, and they start fading off into the
Yeah.
fading off in relevance, because now the thing that they said that they're going to change the industry, they obviously didn't, and now they're just a discount broker, and that seems to be the trend. I imagine you guys will have something akin to that, probably not in the same way, but
Yeah.
I imagine you'll have those guys.
Yeah. Now that you're putting it that way, I definitely agree. That's why we've done a similar, very similar thing to Empire Flippers. I mean, we're more or less an open book where we can be. Obviously, there's regulations and there's some competitive advantages, but I think we've been pretty open about how difficult it is to run funds. You may be able to be a one trick pony and go out and raise, X amount from a small pool of investors and do one fund, but to do this at scale and run the funds and do the distributions and do the acquisitions and migrations and all of that stuff is a really big challenge. So now that we've got these systems and things in place, we just want to continue to get better and better, but also scale. So I think as you're saying that, it makes perfect sense. I think we'll see some copycats, but again, we're very open about it. It's not an easy thing to pull off, and we've learned a lot along the way, and I'm sure we'll continue to do so.
Yeah, yeah, the not easy thing to pull off. So we actually, and you guys will probably see it too, if not already. We've had so many people in our network that went and started a brokerage. Like, once they see like how much money we're making and all that kind of stuff.
Nice.
I had actually had a friend. He told me like, "Hey man, check it out. I'm starting a brokerage." I was like, "Oh, like why? Why do you want me to congratulate you for competing with me? Like, weird, but okay, I'll check it out." And so like I told him like, "Hey man, well, I do wish you the best. Like, generally, I always hope everyone does good. I think there's plenty of pie for everyone to eat, but I'm just warning you, most people that start this, they last for like 2 weeks, because being a broker is actually way harder than people think it is. People think it's like, oh, I just built an email list, send out an email, no problem. Like, man, you got a rude awakening coming, buddy."
Yeah.
And this buddy of mine, he actually had enough of an audience to create decent deal flow, especially for a one person broker team, where he could have made like pretty good money. But the first deal started coming in, and all this stuff, like with the APAs, the negotiations, all that the sellers expected, and like him not being well versed in that, he had sold a few businesses before, but not like a lot. He literally closed down within 4 days. He's like, "Yep,
Oh
not
wow.
doing that. That was a mistake." I'm like, "Hey, I tried to warn you, man. It's not as easy as other brokers make it look." Like, I almost wouldn't wish this business model on my worst enemy, because it is quite an intensive business. It's really fun, but it's a very intensive business, similar to yours. We had, I think, we had Mohit on the podcast a few
Yeah.
months ago, and he's raised money on his own. I asked him, like, so what's the difference between WebStreet and when you were doing it? And he's like, it's so much less stressful. I love it. Like, because he had actually raised money. He's one of the few guys that, I don't know what it's like now, but back then I think he might have been the only portfolio manager who raised money on his own. Yeah, he was just like, this is not easy. So like, Web3 doing this takes so much off my plate.
Yeah, well, and it allows him to really focus on what he's good at, right? So if you got 0 to 100 in bandwidth, whatever units those are, and you're spending 30 of those on raising money and running the funds and investor relations and all that stuff, I mean, that's a large chunk of bandwidth that you're using up and could be used to grow your businesses. But he's been great. Obviously, a lot of people know he's done several funds with us. I wish I had his latest numbers pulled up, but he's got an impressive track record, not just in returns, but in the money that we've raised together and the amount of acquisitions that he's done. So he's been one since round one, and we'll continue to build that track record with him.
Yeah, he's really becoming a powerhouse. I love Mo. He's a good dude. So, with everything that's happening through your funds, obviously you don't have to share any proprietary data or anything like that, but what are you guys seeing behind the scenes at different monetizations, niches, industries? Are there trends that are starting to emerge of like, okay, we've seen this before, this is a really good thing, or like, well, we need to, not do that again? Are you seeing anything like that?
Yeah, so I think there's a few different things. So our content sites seem to be performing, really well, and I don't think it's just us. I think the industry as a whole, I think content sites are still there's a lot of upside there. Everybody gets worried about the new AI and ChatGPT and all that stuff, and rightfully so. But I think one of the trends we're seeing there is our operators, and it kind of goes back to those masterminds and things. They need to be really quick to adapt and embrace those things, and so we're seeing that. Additionally, FBA, we're seeing, it's just extremely competitive. It's a different world than it was 2, 3 years ago. As you hit on, we think that can be a really good thing for us because there's less players entering the space as new businesses. So we can take advantage of buying those businesses that are already established and just let them cash flow and try to grow them, of course, but let them cash flow. And then there's less new players coming into that space. So we've hit on moats a lot, but we're seeing those around the FBA businesses that we're acquiring. So that stays extremely competitive. And then I think Empire Flippers is seeing this too, but we see a lot of opportunity with KDP. There's still less deal flow than we would like out there, but I think that's changing. And, we only have one KDP operator, our portfolio manager so far, but, he's done a great job and we're looking for more and looking for more deal flow. And I think that's going to continue to trend in that direction. So you guys are seeing more KDP, right? Or were you at one point?
Well, so KDP is just like it's a weird business model, right? So
Yeah.
it's like probably the most esoteric business model that we sell millions of dollars worth, and we never talk about it. Like unless I say this exact line, because I've said this
Right.
line to a few people. But lately we've been out. I don't know if you guys have seen this, but lately we've been seeing like account shutdowns in the KDP world. So we're now restricting, not like not allowing it, but we're putting it to a higher level of scrutiny and telling more buyers, hey, buyer beware on this. This is something that's happening. I don't think it's all only because of like black hat stuff. That's something the KDP people are doing that maybe we miss in vetting. But I mean, I think that's part of it. But I also think that the KDP is just doing a ban hammer, which is something
Yeah.
all these platforms do. So it's not something I'm like super worried about. Like everyone goes through a season like this. Like Facebook goes through multiple seasons of it, like every month it seems with their ad account. So it's not something I'm like super concerned about. But yeah, I would say interest in KDP has always been a strangely strong one for how
Mhm.
silent we are about it. Because
Yeah.
again, we just don't talk about it very much.
Yeah, and we've seen that on KDP too. We just had some KDP deals that were pretty far along that got reversed. They were outside of Empire Flippers, so I will say that. But
Oh, good.
those things
Whew.
are
That is
yeah.
why you only buy from us, Kyle.
But yeah, I mean it's a different breed, I guess you could say. But it's something that we're continuing to keep a close eye on. And yeah,
Have
we
you
haven't done
guys?
a that kind of covers the three monetizations that we have under our belt right now. But yeah, I alluded to it. We're pretty sure we're going to bring on a SaaS operator in Q3 of this year. So we'll see.
Are you guys going to do any like DDC funds, like more traditional e-commerce stores?
Yeah, we did try last year. We brought one on, and the investor interest was lower than we expected. So we're kind of put that on pause for now, but it's definitely something we, are keeping an eye on or and are open to. We
Yeah.
just kind of, yeah, the interest has gone down a little bit in that, but I think it'll turn around. We'll see.
Well, I think a year ago you guys were still restricted to our platform too, right?
That's a good point. Yeah, that's a good point. Yeah. So only this most recent round is the first time we've even looked outside, and we were still looking in a pretty limited window. We want to be ultra conservative, as we
Yeah.
expand.
I think there's huge opportunities still in the traditional e-commerce space, like especially if they're not on Amazon or if it's like a very small nascent part of their revenue. Because, like in my view, if you were to ask me which one is better, like which business model is better, hands down, traditional e-commerce is better because you own more of that like bottom of funnel customer data, which I view as like almost more important than the actual profit of the business in a lot of ways.
Right.
But the marketer in me, the data stalkers, like with FBA, if you try to take an FBA business and turn it into a Shopify store, usually you run up against all these problems because Amazon does so much of the marketing and heavy lifting for you behind the scenes. It's just so much easier on Amazon versus DTC. Versus if you have a DTC brand, let's say they're spending like 10K a day on Facebook ads, which is actually quite small for a lot of these e-commerce businesses in terms of their ad spend, and then they go and put it on Amazon, like they could have customers that are like, "Oh, I really liked that shirt, but they lost the ad URL." So they go on Amazon, type in something that's similar, and boom, there it is. Like, "Oh shit, that was my thing." And so you have this like halo effect that you get when your traditional e-commerce running these ads are successful, but you're also on Amazon as like this secondary channel. So I think now that you guys are off from us, where you can go after like the best ones are probably going to be private deals, but like go after that. Like I think that would be a pretty solid opportunity for you guys. Like SaaS too. Don't get me wrong. I think
Yeah.
SaaS is very interesting as well. But I think a lot of people sleep on traditional e-commerce, just how powerful it can be.
Yeah, I think that's a really good point. It's definitely something we're open to and we'll revisit.
Yeah, I'd be curious on that. So we're coming towards the end of the interview, my friend. So we have 3 rapid fire questions. Are you ready?
Let's do it.
All right. Are you sure you're ready?
No.
That's the honesty I seek. That's transparency in action.
Greg and rapid fire. What could go wrong?
All right, here we go. What are the best hidden growth opportunities in investing or online business today?
Besides WebStreet?
That was it. That's the answer. I see what you did there, Kyle. You are a master infomercial man. If you have another answer, you can go ahead, but that's a good answer too.
No, I'm not certain, to be honest. I think, yeah, I don't know. I won't make something up here. I'm definitely more on the operation side of the business. I don't get into a ton on the acquisition side. Who knows with the newest technologies here? I mean, I know you've talked ChatGPT and AI to death, so there's going to be a flood of different things come out of that. But yeah, I don't know. I don't have a good answer on that one.
That is a good answer in of itself. Yeah, I don't know is a uncommon answer, so people will probably trust you more. Like, hey, well, at least he's honest. And a guy, he asked me like, "Oh, don't you just tell people everyone always makes money as part of your marketing at EF?" I'm like, "No, dude. Like, I always tell people that what we saw at Empire Flippers is an opportunity to change your life. They think it's positive. People naturally think that's a positive statement. So then I always add on into my marketing. Remember, we might change your life in a very negative way. It might be a negative opportunity where you lose everything. So
I just
keep that
promised
in
change.
mind."
Just change.
And like, it makes people laugh, but it's true, right? So I don't know. I think it's actually a good answer.
Yeah, I
What
think
tool do you?
I would
Oh, go
say
ahead.
I do think, I think newsletters have had a really big ton of growth around newsletters and helping grow content sites with newsletters. I think the next evolution of that is going to be communities. As people do more with AI and content models continue to change, I think the communities that people build around these are going to be more and more trusted resources versus top 10, waffle makers or whatever. If you're in a community where you truly trust, okay, this guy, I know he travels. I trust his travel gear recommendations. The people that you know in your communities and the communities that people can build around their sites or around whatever businesses they are, I think that's a really big growth opportunity. Not something that's easy to pull off, but that's something that I would, recommend people try to do.
Yeah, I agree with that. I think communities are fantastic. Newsletters, in a sense, even better because you're collecting that email list. Usually, I would start with, get the foundations, your waffle maker articles, whatever, done first, and then get your newsletter going. And once you build up, then maybe you start like, I don't know, a home cooking community of some
Right.
sort. Once you get some traction, don't just go with like 0 followers to start community. That's really playing a hard note.
Good luck.
Just you and your ChatGPT bot talking to each other. Yeah, I agree. That's a great way to scale up a content business. All right. So, what tools or resources would you recommend for people to help them evaluate online business opportunities?
Yeah, I mean, you guys have done a great job for years and years. I think that's something we're trying to really ramp up as we grow our marketing. So, I mean, as we grow our audience and our marketing team, we're trying to do more and more case studies, both good and bad, so people can come find out, what's working, what's not. So, I would definitely say continue to keep an eye on our own blog. It's a shameless plug there, but we're really going to be ramping up our content and, the case studies and things like that we're putting out. Aside from that, I mean, there's all kinds of stuff out there on Twitter and newsletters. I've had to scale that back myself, where I spent way too much time in the inbox each day. So I don't think there's any lack of resources. It's, again, finding those communities and those trusted resources and then building on those.
I feel you. It's not Twitter for me, it's Facebook groups for me. I just have like, I'm in an insane amount of Facebook groups. And so I get like a snapshot every day of how every industry is going. I'm even in this indie fiction author community because, I like to write poetry and books. And
Uh-huh.
all they talk about is AI covers, AI books. We're doomed. I'm like, oh, these are just like my SEO friends. I feel right at home. All right. Final question for you, man. This is the hard question. Are you ready?
Let's do it. I'm
All
really
right, this is
ready.
the easy question. Are you ready? Was the hard question. What has been your funniest moment in the online business industry since you got involved?
Oh, man. There's a wealth of them here. So when I came on board with WebStreet and was training under Mike, along with a few other guys, we were in Colombia, and about a week or two in, yeah, it couldn't have been more than 2 weeks. Joe came out and visited, wanted to meet the new team and train with us for a few days. Flew across the world and started to train with us. Well, we'd brought two new sales guys on at that time and investment advisors, and watching them get to meet anybody that knows Joe and, you know, his personality, getting to watch those guys train in a sales role under Joe, just drinking from a fire hose. Anybody that knows him and knows that crew can probably get a good visualization. Just absolutely hysterical.
I can imagine it now. There used to be a thing that I did that I would always troll like new members of the EF team. I don't do it now because our team grew too big. Where now it's just like it's lost its appeal. I've done it too many times, I guess. But when we'd have new people come on, like a new sales guy, I would send them a message because I know they were working next to each other, like in Colombia or Mexico, wherever they were, setting up shop. Like, hey, are you near Alex? Which is our director of sales back then.
Right.
And I'm like, yeah, like tell him I have the banh mi. And they're like, and they don't know me, right? They just know this is the head of marketing, like messaging me this, like, what does this mean? They're like confused. And then they look at Alex like, hey man, Greg has the banh mi. And I was like, just ignore Greg. Just stop. You've been through so many of these things where I just try to make Alex like uncomfortably, like I don't understand what's happening through his new hires. I love it. It's the funniest way to use role power as a total troll.
That's pretty good.
Anyhow, man, for people that want to connect with WebStreet, learn more about either investing into WebStreet itself or into the funds that the portfolio managers are doing, or if they just want to connect with you yourself,
Yeah.
what's the best places for them to do that?
Yeah, so it's webstreet.co. You can easily connect with us there. My email address is just Kyle, Kyle, at webstreet.co. Really active on LinkedIn as well, and some on Twitter. Any of those options are great. So just reach out. Happy to connect. Love to kind of nerd out on this stuff and talk investing if you want to learn more. Again, we're building a bunch more resources and looking forward to connecting with any of you.
Awesome, man. Well, thank you so much for coming on.
Awesome. Cheers, Greg.
There you have it. I hope you enjoyed it. I hope it got you inspired at all the different things that are happening in this industry. And of course, if you just want to buy a highly profitable business, you can always go to empireflippers.com/marketplace, or maybe you want to make an exit of your highly profitable business, and you could go to empireflippers.com/sell your site. I've been your host, Greg. If you enjoyed this episode, make sure you leave a review, give us a like, a follow, share it across social media. Talk to you all soon. See you on the next episode.